The 1990s tech boom was unstoppable. Microsoft, Intel, Cisco, all shooting to the moon. Everyone was making fortunes. Everyone, that is, except Peter Lynch. The man who turned a tiny $18 million fund into $14 billion walked away from the hottest sector in the market. Why would one of the world's greatest investors ignore what everyone else called the future? And more importantly, what does that mean for investors like you today? Welcome to Seven Hills Equities, where we break down timeless investing lessons and apply them to today's markets. If you're serious about growing as an investor, hit that subscribe button so you don't miss our deep dives. Before we dive into why Peter Lynch avoided tech, let's start with who he was and why his perspective still carries so much weight today. Peter Lynch managed the Magellan Fund at Fidelity from 1977 until 1990. Over just 13 years, he grew that fund from $18 million to more than $14 billion in assets. And he did it with an average annual return of 29%. That's not just good, that's legendary. It put him among the greatest money managers of all time. Lynch became famous for a simple but powerful philosophy: invest in what you know. He believed that individual investors had an edge if they paid attention to the world around them. If you noticed a restaurant chain expanding in your area or a product flying off shelves, that might be the seed of a great investment idea. His concept of the 10-bagger, a stock that increases tenfold in value, became part of the investing vocabulary. But despite being open to all kinds of industries, Lynch made one thing clear: he did not buy into tech stocks during his career. And in the 1990s, that became a defining decision. So why did Lynch avoid technology when it was clearly becoming a force that would reshape the world? First, Lynch understood the idea of the circle of competence long before Warren Buffett made it famous. He admitted openly that he did not understand tech companies well enough to evaluate them with confidence. Lynch liked businesses he could explain in 2 minutes. He liked grocery stores, retailers, and banks. With technology, he felt there was too much uncertainty, too much rapid change, and too much he simply couldn't predict. Second, he was a stickler for valuation. Lynch focused obsessively on the price-to-earnings ratio, comparing a company's growth rate to its stock price. In the 1990s, tech companies often traded at sky-high multiples despite having little or no earnings. To Lynch, that violated his most basic investing discipline. He wanted real earnings, real balance sheets, and real businesses behind the numbers. Third, Lynch cared deeply about durability. He wanted businesses that could stand the test of time. A shoe company or a bank might be boring, but they weren't likely to become obsolete overnight. With tech, he worried about rapid obsolescence. One hot product could be replaced almost instantly by something newer and better, and that made it hard for him to feel comfortable investing his shareholders' money in the sector. Now, looking back, was Peter Lynch right or wrong to avoid tech? The answer is complicated. On the one hand, he missed some of the greatest growth stories of the last 50 years. Microsoft, Apple, and Intel went on to define the modern economy. But on the other hand, his caution also meant that he avoided catastrophic losses. When the dot-com bubble burst in the year 2000, trillions of dollars in market value vanished almost overnight. Scores of companies that had been trading at insane valuations went to zero. Lynch's discipline shielded him from the kind of mistakes that destroyed countless portfolios. And that brings us to why this story still matters for investors today. We live in a world that feels a lot like the 1990s in some ways. Artificial intelligence is everywhere. Nvidia dominates the headlines. Tesla, Meta, and dozens of new AI-focused startups are being priced as if they can only go up. Investors are chasing the next big thing, afraid of missing out. But if you study Lynch's approach, you realize that his lessons are timeless. First, stick to your circle of competence. If you don't understand AI chips or biotech pipelines, you don't have to invest in them. It's better to stay disciplined than to throw money at something you can't explain. Second, valuation still matters. Lynch constantly compared growth rates to valuation. He wanted the growth rate to justify the price. In today's market, many high-flying stocks are trading at 50, 80, or even 100 times earnings. If history teaches us anything, it's that paying any price for growth is dangerous. Third, discipline beats fear of missing out. Lynch wasn't afraid to miss a few winners if it meant avoiding dozens of losers. And when the dot-com bubble collapsed, that discipline proved to be invaluable. Finally, focus on the long game. Lynch wasn't trying to predict what would be hot in the next 6 months. He was looking for companies that could compound over 10 or 20 years. And that's still the name of the game today. So here's the bottom line. Peter Lynch didn't avoid tech because he thought innovation was bad. He avoided it because he knew his strengths and his limits. He understood his circle of competence and stayed within it. That's a timeless lesson every investor can use, especially when the market is filled with hype and noise. Thanks for watching 7 Hills Equities. If you found this breakdown helpful, make sure you subscribe for more investing insights, strategy deep dives, and timeless lessons applied to today's market.